All right, thank you everyone. We will now begin panel 2 on distressed opportunities. I'm going to introduce our panelists here. We have Claudia Piper from Webster Bank. She's a senior vice president at Webster Bank. Then we have next to her Jeff Gronning. He is a managing principal at Normandy. And we have Paul Marcus, who is the founder and CEO of Marcus Partners. And next to him, we have David LeBlanc, who is managing director at DebtX. And our moderator, Todd McGrath, will now take us into panel 2.
Well, we'll make it live. Is that it? Okay. What I'd like to do is maybe just start out by having our panelists spend a minute or two to describe what aspect of the real estate capital markets or asset markets they're spending their time in terms of either addressing or pursuing distressed debt opportunities, so you get a sense of what our panelists do day to day and what they're trying to accomplish. And why don't we start on the debt side first, maybe with Claudia.
I've recently made a transition from spending the last 2+ years on the workout REO side at Catmark Bank to now being back on the origination side at Webster Bank, which is a regional bank that focuses on the middle market CRE sector. So for the past 2 years, I was spending my time mostly trying to at least attempt a restructure on a deal that might involve breaking the original note up into a couple of pieces, usually an A note that would be supported by the current cash flow and a solid debt service coverage. The developer would bring in some new additional equity, and then we would structure a B note and potentially a C note. And then many times that was not successful, and I was on the REO side. Currently, in my role at Webster on the distressed side, again, I'm on the new business side, but what we're seeing are a number of opportunities with developers or investors either doing DPOs with an institution they currently have their debt with, or buying a distressed asset either through a note purchase or buying the real estate directly. So for instance, right now I'm in the process of closing a deal on an asset that the former owner bought the property back in 2007, right at the height of the market, leveraged it with 80% debt, and my current client bought that note a couple of months ago at 50 cents on the dollar, so the basis has been completely reset, and we're lending 65% on a non-recourse basis with some additional dollars for them to lease up the property. So those are just sort of 2 examples of the things I've been working on.
All right, as moderator, I'm going to jump in. Claudia, you used a buzzword or acronym, DPO. Could you define that for our audience?
Sorry, discounted payoff.
All right, very good. Super. David?
My name is David LeBlanc. I'm a managing director at DebtX. We are a loan sale advisory group. What that means is we work with banks and other financial institutions that are looking to sell loan assets. We do volume ranges anywhere between $3 to $5 billion a year. About 2/3 of that has some sort of commercial real estate concentration. Loans tend to be on the smaller side. Vast majority are, say, under 40 or 50 million. Almost, I would say, call it 90% are sort of the 1 to 20 or $25 million traditional bank lending arrangement. We do 10 to 15 engagements a month that can range from anywhere from 20, 25 loans to in the hundreds, depending on the portfolio. So volume is fairly fast, it's fairly furious, it's a very, very active market. At the same time, it's also a very private market. Most of these loans are not syndicated. On some of the larger deals that get the headlines, there's some expectation that all or a portion of the capital structure will change hands. With most of the smaller banking relationships, there is an expectation that loan will stay with the originating institutions. And for various reasons, most lenders like to keep the trades confidential. good example of the types of deals that we work on would be about a $400 million portfolio that we did last year. Our bank was, at the time, about a $10 billion financial institution based in upstate New York. They purchased a $5 billion bank in southeastern Pennsylvania and circled approximately $700 million on that bank's balance sheet that were deemed to be classified or substandard assets. We analyzed the portfolio and came up with approximately $400 million in 150 to 200 loans that were deemed to be substandard. Over a period of 3 months, we analyzed the loans, we pooled the loans, we marketed the loans, we created pricing levels for the loans, sold the loans in the secondary market, and this bank went from an institution that was deemed to be kind of on the edge by the FDIC with NPLs in the 6-7% area to an institution with a very, very healthy balance sheet that could now begin lending again.
NPL?
Non-performing loans.
Thank you. Paul?
I'm the only one that created a slide. We'll see if it works. Doesn't. So anyway. Anyway, so we're a value-oriented real estate firm. Just the first slide, that's all we need. There we go. East Coast, east of the Mississippi. We're both operators and looking at financial positions. We primarily deal in the office, warehouse, and medical office world. We raised a fund and closed it actually 2 years ago today, April 1st, 2009, on purpose. We currently have about 4.5 million square feet of assets under management in a former portfolio and a new portfolio of stuff we bought, and we did about $800+ million of transactions in 06 and 07 coming out of the market. What we're spending our time on today is looking at both debt and equity fee deals up and down the East Coast. These days, right now, the biggest value deals that we're finding are Southeast, Atlanta, and suburban Metro New York.
Okay, great. Jeff?
Sure. Just by way of quick background on Normandy Real Estate Partners, we are a fund sponsor. We manage about $1 billion of equity through 2 funds. Our portfolio is about $4.5 million in terms of aggregate value, and we manage about 15 million square feet, primarily in the Northeast corridor. Our company's geared, we're value-added investors. We manage and create value in all the assets that we own directly through our fully integrated operating platform, and we're active investors. We've most recently been very focused on distressed debt. And for us, it's really a way to get to the real estate at what we think is a more attractive basis than what you might find if you were just kind of out competing in the general market for direct properties. In the last 2 years, we've acquired positions in about $1.2 billion of debt. So we've been very active. I think the most notable thing we've done over the last couple of years is the loan to own on the Hancock Tower, which we subsequently sold for a large profit. And we've done that on numerous other examples, just not quite to the same level of visibility. But we've been very active. We've been very successful in the distressed space, and it's something that we want to continue to focus on going forward. Having said that, that's about where I spend 80% of my time. The other 20% or so, I spend dealing with bankers like Claudia on some of the legacy assets that we own. So we've actually got experience both on the buy side and on the as a borrower in terms of working out and dealing with distressed and legacy situations.
All right, great. Hey, why don't we get the retrospective question out of the way right up front? Did things turn out the way that you thought they would? If you think back to early 2009, 2 years ago, and if not, what surprised you the most? Jeff, we'll keep going with you.
Sure. I would say no. I think the conventional wisdom, kind of in 08, 09 was that, wow, this is 1992 all over again. Where's the RTC? Let's, get the big trucks. We're going to back them up, fill them up, and, make a ton of money. There's going to be a tidal wave of, distressed product that's just going to flood the market, and it's just going to be great. That's if you're on the buy side. That really never happened, obviously, and I think there's a number of factors why that's the case. Interest rates have remained, very, very low. I think that's given people, sort of a form of life support, in terms of being able to meet debt service payments over the last 3 or 4 years. I think banks have been very unwilling sellers, up until now. Every bank was at the movie in the early 90s. They saw how much money was made by, bulking out assets at deep, deep discounts. And they didn't want to sort of repeat that. So they've been, holders on of their paper. And so I think those are probably, 2 of the main reasons why we haven't seen as much deal flow as people would have thought. And I think what hasn't surprised me is how long it's taken. I think we're a number of years into this, and it's still ongoing, and it's going to keep on going, and that hasn't been that big of a surprise, frankly, given how deep the recession is.
Let's stick with the buy side. Paul?
I agree with almost everything that Jeff said. I think it's very simple why it is what it is. And I think that Mohammed El-Arain said it well. It's what the Fed is accomplishing, and they're accomplishing exactly what they wanted to accomplish. My biggest surprise is how short the memories are of everybody in this business. And I believe that, I think Southwest had the commercial that came on and said, "It's on." And I believe it's on again.
Okay. All right. How about from the Claudia, from the debt side?
I would agree that it's not turned out as I expected. I think one good indication is that the volume of bank real estate loans that were projected to mature in 2011 have doubled since 2008. So now we're at a level where the bank loans, this again, not CMBS, but the bank loans projected to mature this year is about $900 billion. And that's because a lot of, many, if not all institutions have been, restructuring where they can. Some it's, blend, pretend, and extend, but, we're, if possible, the institutions have the luxury because the regulators are not pushing banks to get the distress off their books, and, we're able to restructure deals differently in this cycle than we were able to do initially in the early 90s. And so it's allowed, that pushing off of the ultimate maturity.
Good, and we'll talk a little bit more about that. David, you must have been licking your chops with all this distress building.
I think the only thing I would add, and I absolutely agree with everything that's been said, the only thing I would add is the magnitude of the capital flow has surprised me going all the way back to 2008. And what's really surprising is not so much that Lone Star raises another fund, or Whitehall, or Apollo, or Normandy. It's sort of the large headline grabbers, but the smaller pockets of capital that entered the space going back to, call it early 2008, when the FDIC first started making the headlines. The smaller pockets of capital, a couple of guys with $5 million, small friends and family fund with $30 million. That capital flowed into the market almost immediately. It was remarkable that the wealth was moved from the guys owning, say, commercial real estate or a small business or what have you, right into the distressed space. And you just didn't see that 15 or 20 years ago. And it was purely a function of information being available and a tremendous amount of wealth in this country. It wasn't until a little bit later that kind of the Fed intervention and monetary easing and monetary policy sort of started to prop everything else up, and then we saw this flood of capital now coming in, and CMBS and asset purchases and the like.
All
So
right.
it really goes way back to, call it, beginning of 2008.
Okay. So is there any pressure that's building up in the financial system to start loosening up some of these assets so that deals can get done?
I think deals have been getting done. Deals will continue to get done. I don't think it's going to be some sort of impetus that all of a sudden creates a flood. I think that banks, every quarter that goes by,